All right, let's dive in. Today, we're doing a forensic audit of a government program called the Saver's Credit. Now, this thing was created with the best of intentions, really, to help regular folks save for retirement. But as you're about to see, what it says on paper and what happens in the real world, well, that's a whole different story.
So, let me ask you something. What if I told you the IRS might give you a free $1,000 just for putting your own money into your own retirement account? That's basically the sales pitch for the Saver's Credit. And yeah, it sounds way too good to be true, doesn't it?
And that number, $1,000, it's absolutely real. A single person can get a tax credit for that much. And if you're a married couple filing together, you can double it to $2,000. On paper, it's one of the best saving incentives out there.
But this is where our audit starts to uncover a completely different reality. See, underneath the surface, this program is just riddled with hidden traps and something called statutory friction. That's a fancy way of saying the rules themselves create a massive gap between what the law is supposed to do and what it actually does. And this friction, it causes that $1,000 to just vanish, especially for the people who need it the most.
So first, let's just understand how this is supposed to work. The easiest way to think about it is like an IRS match. For every dollar you put into your retirement account, up to $2,000, the government says, hey, we'll give you a piece of that back as a credit on your taxes.
But right here, this is the fatal flaw. The Saver's Credit is non-refundable. What does that mean? It means it can lower the taxes you owe, maybe even to zero. But if you don't owe any taxes to begin with, the credit is worth absolutely nothing. You don't get a check in the mail, it just evaporates.
So think about it. Who tends to have a very low or even a $0 tax bill? Well, it's often the exact people this program is supposed to help. Low-income workers, retirees. You know, their income is low enough that after things like the standard deduction, they don't owe any tax. So for them, this incredible IRS match just disappears into thin air.
And you know, as if that massive design flaw wasn't bad enough, there's a huge awareness problem. Studies show that fewer than half of the workers who could actually get this credit even know it exists. I mean, you can't claim a benefit you've never heard of, right? So we have this awareness void that stops people before they even get to the complicated parts.
So you end up with this split reality, a credit that's on the books to help savers, but it's built in a way that the intended beneficiaries often can't even use it. And believe me, this flaw is just the beginning. It builds into even bigger, more dangerous problems. Okay, this next part of our audit, this is probably the single most dangerous flaw in the entire program. It's a rule that I call the netting trap, and it literally punishes people for having an emergency and using their own savings.
To get how this trap works, you have to understand something called the testing period. The IRS doesn't just look at what you did this year. No, they look back at this tax year, the 2 previous years, plus the months leading up to when you file. We're talking about a look-back window that can be more than 3 years long.
And here's where the trap springs. The IRS takes your retirement contribution for this year, but then they subtract any money you took out of your retirement accounts during that entire 3-year testing period. This is a clawback calculation, and it can easily wipe out your eligible contribution and bring it right down to zero.
Let's make this real. Imagine a retiree who gets hit with a sudden medical bill. You know, a classic liquidity crisis. They have to pull $4,000 out of their IRA to pay for it. Later that year, they get back on their feet and manage to contribute $2,000. But because of that netting rule, the $4,000 withdrawal completely cancels out their $2,000 contribution. They get zero credit. They're literally penalized for having an emergency.
And oh, it gets worse. Because that testing period is a rolling 3-year window, that one withdrawal doesn't just hurt you for 1 year. It follows you. It can create a cascading ineligibility that kills your chance of getting the credit for up to 3 straight years, all from one single emergency withdrawal. It's unbelievable.
All right, the next major hazard we found in our audit is what's known as the AGI Cliff. AGI just stands for Adjusted Gross Income. And when it comes to the Saver's Credit, the income limits are just incredibly strict. So take a look at these rates for a single person in 2025. If your income is under about 23 grand, you get the best rate, 50%. But look at how fast that falls off a cliff. The next level is 20%, then 10%, and then boom, 0. These aren't gentle slopes, they are sharp, sudden drops. You want to know how brutal this is? Check this out. The difference of a single dollar. If you make $23,750, you can get the maximum $1,000 credit. But if your income is just $1 higher, $23,751, your credit rate plummets from 50% all the way down to 20%. Your maximum credit gets slashed by $600. $1 of income costs you $600 in tax credits. It's just a shocking penalty.
So after digging through all of this, the non-refundable trap, the knitting clawback, the AGI cliff, it becomes pretty clear that the system is just broken. But, and this is important, there is some really good news here. A fix is on the way. Congress finally recognized these problems and a much better system is coming.
So get this. Starting in 2027, this flawed Savers credit is going to be completely replaced by a new program. It's called the Savers Match, and it is designed specifically to fix the biggest problems we've just been talking about.
The difference is night and day. The old Savers credit, it's a non-refundable credit that just lowers the tax you owe. The new Savers Match, it's an actual government match that gets deposited directly into your retirement account. This completely solves that non-refundable problem. If you're eligible, you get the money. Period.
So, to sum it all up, the new system is a 50% match from the government, up to $1,000 per person. And the most important part is that the money goes straight into your IRA or 401k as real cash. It's not a phantom credit anymore that can just disappear. It's real money that will actually help you save.
So this change in 2027 is a huge improvement. It finally gets the program to do what it was supposed to do all along. But it does leave us with one final, pretty sobering question. For all the years this broken system has been running, how many people have missed out? And how many billions of dollars in savings have already been lost for good?